much for coming out here today. We're really excited about this presentation and are happy that people are trickling in the room right now. So today's presentation is Kapor Capital's workshop on how to go about pitching a social impact VC. So before diving into this conversation, I just want to get a lay of the room of who's in the audience. So for those entrepreneurs in the house, can you please raise your hands for me? Great. Keep those hands up. Well, we have a lot of entrepreneurs. Now, for those that are social impact entrepreneurs or define themselves, keep your hands up and everybody else hands down so we can see. Oh, great. Let's put those hands down. Now, investors, angel investors, impact investors, please keep those hands, raise them high because we have people probably raising money. Keep those hands up high. Oh, okay, so we have 3, 4, 5 folks in the room. Great. We can put our hands down. Thank you for that. I think it gives us good context of who's in the room and also helps inform our conversation today. So why don't we get started? So here are really the 4 things we want to focus on ensuring that you know when you walk out of this room. The first and probably most important for us is there a one-size-fits-all definition of social impact in the investment community? The second point is just understanding who Kapor Capital is and what our specific approach to investment is. And the last 2 bullets, those are also very specific to Kapor Capital because we'll talk a little bit about our experience. But what do we look for in investments? What makes an investment attractive to us? And lastly, what should a founder expect to be asked if they're having exploratory conversations with folks on our team? So, with that said, in practice, social impact investing is actually a pretty nebulous subject, right? There's not a clear-cut definition. I would say that when you talk to most investors, it's really important, especially our tech entrepreneurs in the audience, to understand what their underlying investment thesis is, because most of them are very different. So I put up this particular continuum so we can understand what the landscape looks like and what we see. So on the left side, in the orange section, you have an impact investor, but one that isn't focused on financial returns. It's typically the family office, the philanthropy, people investing in nonprofits. So their motivation is purely for impact, not really recognizing financial returns, although there could be potential upside. As we keep going down the continuum and moving towards the right, on the green side, you have 2 types of investors starting to emerge. One is considered a double bottom line investor. That's a person that values impact just as equally as they do to financial returns. And going further down the spectrum, you have the investor that is focused, again, impact, but the financial returns are what they give the priority to, and then the impact is kind of a nice to have approach. So what was missing in that continuum is this concept that I think often is overlooked in the investment community or in general, that all businesses have social impact. And I want to stress that again. All businesses have social impact. Some businesses may have positive social impact on society. Others may have negative impact. And others are almost like a hybrid. They're an in-between. So I took the opportunity to put up this matrix. 2 sectors here. When people typically think of education investments or even healthcare IT investments, you automatically, like the first thing people think about is impact. And today we're going to challenge you to think that that may not necessarily be the case because we have such a different definition across the board for investors. So looking at the matrix now, let's focus on the first top 2 rows for education. We have General Assembly. Now, keep in mind, all these companies are venture-backed companies and doing pretty well. So the first one is General Assembly. It's a post-secondary educational institution that offers coding boot camps, product design classes, UX, basically a lot of skills that are important for someone to level up and be successful in a tech career. Maybe someone who might want to switch careers would go through a General Assembly. Now, the way they make money is they pay. You have to pay a particular tuition. So for their coding boot camp, for example, you would have to take 3 months off of your job, and you'd pay somewhere between $12,000 to $15,000 a year. They've been really amazing at giving out scholarships as well. And now on the other, probably still in the same space, exists Make School. Make School is actually, for full disclosure, is in our portfolio. We're a seed investor in Make School. They're also in the post-secondary education space, and they provide an alternative to a 4-year computer science degree, basically going through a 2-year program, and out of that program you should have the skills to be an iOS engineer at one of the big startup tech companies. But what is really interesting in the business model that they have created, they've done away with upfront tuition, right? They've done away with upfront tuition, which democratizes access to people who may not have the financial resources to pay up front. So as soon as you get an internship or you get a job, you start paying back the money. And I think that for us is very interesting as investors in terms of the impact piece. So what I want you to take away from this portion is that defining social impact investment is very different. And as you go and start talking to investors, really make sure you understand what type of impact investor they are, and also understand what type of social impact company you want to be.
Great. I'm going to go mic free. Can everybody hear me okay? So, Karen, thank you for setting the stage. I think the next obvious question is where do we capital today? Investing in this, probably the best way to walk through that is to say what the capital through our investment criteria. to run your office. So on the Q side, with Managed by Q, they're given an iPad tablet that comes preloaded with Q software. And from that tablet, they're able to, on an on-demand or scheduled basis, anyone in the office, an office manager or an employee can have a conference room cleaned or wall painted or toilet paper stocked, new stuff, whatever it may be. And so the market is big, right? The office cleaning market is huge, right? So that would be one check if you're thinking about why would we care? Big market. But who are the people who are doing these jobs, right? These jobs are typically done by low-income people across this country. Disproportionately, low-income people of color. And Managed by Q had the foresight really to, from launch, classify all of the field operators on the platform as W-2 employees rather than independent contractors, which is a trend that we've seen in this on-demand gig economy, people being classified as independent contractors. Managed by Q had the vision to classify folks as employees, giving them health benefits, 401k, paid parental leave, as well as benefits like free GED classes and tax credit. And so this is a business that is really creating significantly above minimum wage, or as we would call living wage jobs, in a community that didn't previously have this, right? Amongst a group of workers that didn't have those benefits. One of the really novel things they've done recently is announced that over the next 5 years, they're going to contribute 5% of the equity of the company to these field operators. And so again, to kind of tie this down, you have folks who are building a business, right, that has a vision of kind of shared prosperity, giving back to their employees, their low-income people of color, in a really big market. And I think, one of the things that, will weave throughout both Carolyn and I's remarks is the importance of diversity in the workplace, diversity and inclusion in the workplace. And I hope it's not a surprise. I see a pretty diversity of folks out here today, to anyone in this room, but we believe very strongly that there is, and it is shown, countless studies have shown, the correlation between financial performance and diverse and inclusive workplaces, including this one recently done by McKinsey, the Diversity Matters report. They surveyed over 366 companies, right? And in that study, they found that those companies that were in the top quartile of gender diversity outperformed industry median on a financial basis nationally by 15%. Those that were in the top quartile for racial and ethnic diversity outperformed by 35%, right? So this is diversity matters, and it's something that we should all be thinking about when we're building our businesses. And it's absolutely something we think about when we're evaluating investment opportunities. We ourselves at Kapor Capital are a very diverse group of folks. These are our faces. Half of the investment team, the partners on the team are Black. And with respect to the broader investment team, we have 2/3 made up of Blacks and Latinos. And this is really, when you talk about, if you look at the state of venture today and kind of the lack of funding for people from underrepresented backgrounds, I think it's, part of that comes from not having teams that look like this, right? We're able to source those opportunities and think about those issues because the people who are sitting around the investment table reflect the people that we're investing in and the problems that are being solved. In our current portfolio, over 61% of the companies have a founder that's a woman or a person of color, so Black and Latino. And I think it's fair to say, before getting out here today, I had a chance to speak with several folks, and they asked me, "Oh, you work with Mitch," and then kind of talk about the work that Mitch has done and Mitch and Frida are known for. I think it's very fair to say that over the last couple of years, they've doubled, if not tripled down on their commitment to diversifying the tech ecosystem. One of the ways they did so was through the $40 million commitment that was announced last year, of which Kapor Capital will be investing $25 million. So for those of you who are looking for funding for social impact businesses, you should talk to us. Another is through the Founders Commitment that we launched earlier this year. This is something that we're really excited about. So the Founders Commitment, it's an opportunity for us to work with our portfolio companies collectively around creating more diverse and inclusive workplaces. And 100% of the companies that we're investing in on a go-forward basis sign this commitment. So what does it kind of entail? I think actually I'd probably policy say that already 2/3 of our portfolio have signed up to the Vator Commitment. And it's around 4 principles that we organize under the acronym GIG. The first G being for goals, we ask the founders that we're investing in to set goals around diversity and inclusion that are appropriate for their company. This is not a one-size-fits-all, you need to do X or Y or Z. It's really, what is appropriate for your company, for your sector. Set goals and then report on those in the same way that you, the entrepreneur, are reporting on revenue and traction, right? The second is I for invest. Investing in tools and trainings that help mitigate bias in the workplace. The third V is for volunteer. Organizing volunteer opportunities in underrepresented communities and communities that reflect your customer base. And the third is E for educate, right? We offer a lot of trainings. I've already done several of those in person and virtually to help keep folks in our portfolio abreast of new kind of thinking around diversity and inclusion in the workplace and the importance of that. So I'll turn it back over to Carolina to kind of continue on the theme of the conversation.
Great, thanks, Anthony. So Anthony has done a really great job of giving everyone an overview of what our investment thesis is, right? I want to hone in on the fact that Kapor Capital specifically is focused on investing in entrepreneurs and founders who are focused on reducing or closing gaps of opportunity and access, right? We're closing gaps of opportunities and access for underrepresented low-income communities of color. And I will say, and preface this again, that every investment fund has a very different approach. This is specifically our thesis. Now, we're also venture capitalists. We expect venture level returns in businesses to scale as such. So this actually, when you're an entrepreneur, I knew that there were a lot of entrepreneurs in the room and you're thinking about seeking investment. What we're going to discuss now, it comes across the board for any type of investor, impact or non-impact, non-social impact investors as well. So I would say when a company is ready to seek investment, it's really important to have something that is built and it's not necessarily a concept. So often one of the biggest mistakes that folks make when they're coming to try to speak to us is they have an amazing idea, but there's nothing around for Anthony, I, and my colleagues to play around with and actually test out. You should come and start talking to folks when you have a minimum viable product or what's called an MVP or some type of prototype. I think that's super, super important. Again, most people try to come in with concept. I would say the only time I've seen folks try to pitch concept and get funded, it's because they've had a significant exit, so they already have a track record of running a company, selling it, or going to IPO. And those folks
have an easier time raising on concept. The other thing that's key is traction, right? And that looks different across the board if you're a consumer type business versus an enterprise. So if you're an enterprise business, things that we would be looking at, do you have pilots in place, paid pilots, some type of contract that is longer than a year? Those things are important key metrics that we evaluate. On the consumer side, what does the usage look like? How often are people using your platform? Is there week over week growth? Are we seeing something that looks like a hockey stick? And lastly, because we're seed stage investors, typically the folks that are coming to us and raise money, raising anywhere between $750,000 to $2 million. So that's really important. When you're talking to investors, get a range of what their typical, what entrepreneurs are typically raising. So that's our range. So if someone came to us and said, we're looking at a seed, they meet all our criteria, they meet the impact thesis, we're raising $1 million, then they should be having a conversation with us and we would be most open to it. So I put out this chart because it outlines some key categories that we think about when we're talking to entrepreneurs. So let's say this is a use case. You are someone that is an entrepreneur, social impact, and we have decided to reach out to you and maybe have an exploratory conversation, and you're thinking about, well, what questions should I prepare for? These are some of the questions, and these are the categories you should be thinking about when you walk into those meetings. So market. I would say a lot of conversations that I have with some folks that come to pitch us is they'll talk about disrupting a market that's in the hundreds of millions of dollars. When you're a venture investor, you actually want to look at markets that are in the billions of dollars, right? Because that's a total addressable market and you're only going to be taking a small portion of that. So think big, think really big. And if the market doesn't exist yet, what are you going to create a multi-billion-dollar market with your product. Product we touched on a little bit. Something, no concept, it should exist, prototype or MVP. One other thing that I want to really hone in on is the concept of a team, right? As seed stage investors, you really invest in people. So when you're thinking about teams, one thing that's really important, have the people who are solving a particular problem, do they have the lived experience? Do they have some type of domain, sector experience in the space? What is going to give me the confidence to think that I can put money on you and that business will take off? Another key thing that we often see is folks come to us without technical founders. Sometimes they outsource. Now, one of the big challenges that we see with that and why we strongly encourage people to have technical co-founders is because the business that you may have started out may not be the business you end up. You need to be agile enough to be able to pivot and create a new iteration of the product. And if you're focusing on outsourcing that to Uzbekistan, might be very difficult to do, right? The other key thing is competition. I'm always surprised when people come and pitch and they say there's no competition. There's always some type of, there's direct competition, but there's usually something called indirect competition. Now in spaces that you're going in that are very cluttered or crowded, like let's look at the shared economy space. Some folks might want to create another competitor to Uber, which is probably very difficult at this time, but it's a very cluttered space. If you are pitching something that is in a cluttered space, it's important to think about what is your secret sauce that differentiates you and makes you 10 times better, at least 10 times better than anything else is out there. That's going to give confidence to the investor. And lastly, for us, it's always about the thesis. Does it meet our thesis, which is social impact? And then if it does, then we start looking at all these other categories. So process. That's a question that I think a lot of people, when they're talking to us, should be asking us. What is your process, right? How long will it take for you to get a decision back to me, particularly if you have a tight deadline and you want to close your round? Every firm likely has a different process. This, in a nutshell, is Kapor Capital's process. So I'll walk through it very quickly. Sourcing, something comes to me, Anthony, myself, someone else on our investment team, then starts going through an evaluation process. The evaluation process is typically an exploratory conversation on the phone. If we get a little bit more interested, it's additional diligence, having in-person meetings, up until a point, we do a little bit of diligence that it gets in front of partners. Once it's in front of partners, the partners collectively make a decision if they want to make a commitment or what's called a financial commitment, an investment in the space. Typically, our investments, specifically Kapor Capital, because we're seed stage, we're making investments anywhere between $100,000 to $250,000. The average check size that we're writing right now is $150,000. So you get to the point, we've made a commitment, now you actually have to start negotiating or structuring some types of deals. And usually, there is what's called a lead investor. We don't take lead investment positions, we don't take board seats, but the lead is set in terms of the deal. Now, one thing folks think about is, well, I've raised money. And on our end, what's most important to us is getting the business to get to Series A. So the easy part of my job, frankly, is cutting checks. The hard part of my job is getting someone from a seed stage all the way up to Series A. And we are very active investors. So as soon as you get a check from us, it comes to the point where you have a lead partner assigned to it, then you have a team, and those people are coaching you or meeting with you throughout the process to get you to A and making introductions. Given the Rolodex of contacts that we have, we've been very successful introducing our portfolio companies in seed to other potential Series A investors and then beyond. And again, we are social impact. We're also a venture capital firm. So we look to make exits in these businesses either through some type of IPO or a sale, acquisition, or merger. So we've talked a lot. We spent a lot of time talking about the theory, our investment process, and I actually wanted to turn the tables a little bit to make this much more interactive and talk about a particular case. This is a fictional case. Fleming Schools does not exist, so no one can tweet that I'm saying bad things about Fleming School or good things about Fleming. So let me give you the scenario of what Fleming Schools is. Maria Gonzalez, woman of color, first-generation immigrant, was one of the founding team of Twitter, starts a company. And her company is Fleming Schools. And the problem she's trying to solve is because it's really hard for her to find quality schools for her child. So she decided, I'm going to create that. She's built a brick and mortar network of schools, K-8, based in Brooklyn and Prospect Heights. And what's really interesting about her school is that she has some technology in the school, embedded in the school. So when students come in, they go to a computer and they essentially have the equivalent of a Netflix for schools, right? Customizes your curriculum, the child's curriculum, based on how they learn. And that to us, very powerful, interesting, because it's not something that can just be done in US schools, but actually grows out throughout the world. So that's her innovation in technology. She charges a tuition for the school, but gives a lot of scholarships in place. And now she's at the point where she wants to raise additional money. She's been bootstrapping it. The seed round that she wants to raise is $1.5 million. So that kind of sets up the scene. And now what I'd love you to do, because we've broken out in tables, maybe just for 3 minutes or so, just talk about amongst yourself if you would consider investing in such a business, the pros and cons to it, and if you think Kapor Capital will invest in it. So in this case, I think it's really important to assume that the revenue is there because we get it from tuition. A lot of people, there's a huge demand for schools, but does it fit what we consider the social impact thesis, right? Because that's the first thing we tend to look at. So I'll give you 3 minutes, and if we could just chat amongst ourselves, that'd be great. All right, so now that you've gone through this exercise, just want to see a show of hands. How many people would think that we would invest, that Kapor would invest? Hands up. 2, 3, 4, 5, 6. Okay, cool. Okay, so how many people would not invest? How many people would not invest? Hands up. Okay, hands down, okay. And then how many people were on the fence? They weren't necessarily sure. Okay, that's a lot of people. So this makes for a really good discussion. So since we've talked in groups, does one table want to tell us, what their thought process is or some pros and cons? Oh, okay, back of the room. This is correct. We did not invest. That was a really great analysis. Wow, you should be up here too. That was really impressive. But it's also iffy, right? Because you have someone, right, that has had an exit proven, could definitely execute on this business. Were there other, I also saw 6 hands, right? So 6 hands that said, that we would consider investing, and just want to get that perspective, right? Because the reality is there's never a right or wrong answer. This is just, our thought process, and we do this every day. This is what we do. We think about businesses like this. Yes, in the purple. So let's talk about that again. So social impact, how would you define the social impact in this case? Helping students learn, right? Any other thoughts on why? Okay. That's both, again, very good perspectives. Company like this did get a lot of funding, but going back to the first person who answered the question, we would actually pass on this, right? So when we went through that continuum, right, it was difficult, right? You have a founder that you could definitely bet on, a lot of domain experience, they could bid this out. But from an investment standpoint, brick and mortar is difficult to scale, right? That's aside from impact, brick and mortar, it's like building Starbuckses, right? Starbucks of schools. Very, very difficult. The technology innovation is interesting to us. So sometimes there are businesses where we see a lot of the criteria, but maybe missing the social impact piece. And we actually push back because we think that there's something special about the founder, and we'll consider having them come back to us and say, is there some type of innovation where you can democratize access to the school in another way? So when I think of this company, and this is a use case that I made up, I think, well, could they actually sell the technology, right? The school, the tuition of charging the schools for the brick and mortar, right? Let's flip this on its head. It's the technology that is actually valuable. And can they actually find a way to sell it into K-12 schools, international schools, and then that becomes free and accessible to kids and parents who normally wouldn't get it, rich and poor, right? It's an equalizer for us. So thank you. We're going to spend some time doing Q&A, but I really appreciate you actually going through the thought process. This was a test for Anthony and I to do it, so I think it went over really well. And again, I do want to leave us with a closing remark that every business has a different way of defining impact. And what I think as investors we need to do is what type of impact do we want to make? And as you think about raising funds as tech entrepreneurs, what type of impact is important for you and your company. So we'll open it up to Q&A. Any questions? Oh, thank you. Great, we have a question there. Yeah, go for it. Got it. Perfect. Other questions or other thoughts? Oh, okay. Why don't we go here and then to the woman in the back and then someone over there. So let's start here. It's a working prototype out of, you've gone through beta, other people are using it, right? It's in the App Store, right? You've gone through the private beta and now it's working, right? So I think that's really important because I always push back. Sometimes I meet such amazing founders and I'm like, this person has something, but you're just too early. And what we'll do is we'll track the business. So we'll say, stay in touch, we'll continue to talk. But it's easier for us, like our job in many ways is to say no, right? My job is to say no. And it's to say no because we have, I would say last year we had 2,500 pitches come in, and we only do between 17 and 20, right? And that's across the board. That's not just Kapor Capital. This year we're probably slated to get over 3,000, right? And we want to be able to mitigate and only make a handful of investments. So your job as an entrepreneur is to get me to say yes. Right? Your job is to get me to say yes and not to say no. I don't like saying no. Get me to say yes and follow those criteria, right? That's the key thing. In the back, the young woman. Mm-hmm. Yeah. That is a great question. So I do have domain experience in schools. I started school and went through and exited an ed tech company. So when I think about education, I think about it in three kind of buckets. There's what's called like pre-K or the Series 6 space. Then there's the K-12 space that most people think that they just end up creating ideas for K-12. And then there's the post-secondary kind of community, college, university space. So I'm assuming you're talking about K-12, right? So when people think about K-12, most of the money is in Title I schools. The money is in the poor schools. And there are three types of buckets. Enterprise sales are very, very difficult. And I would say most traditional investors shy away from investing in those in schools because sales cycles take 6 to 8 months to get to pilot. After that, you got to do a school contract. But if you do a contract, it's super, super sticky. So when I talk to entrepreneurs, it actually really depends on what you're trying to build. So if you're trying to build another learning management information system that's been done, I wouldn't do it. If you're trying to build something that tackles three particular areas, and I have a very strong thesis on this because it's a space I know very well. If you're trying to tackle something in special education, if you're trying to tackle something in the teacher training professional development space, and if you're trying to tackle something, I would just say actually those two buckets. Oh, I'm sorry, I said special education, teacher training, and English language learning, right? Those are three buckets that most people don't even think about. But those are actually the ones when you're selling into school, have the most amount of money, and it's easier to sell into those spaces. So I would ask you to think about, like, does your product fit in those buckets? And then I wouldn't be afraid, and I as an investor wouldn't be afraid of investing in those three spaces. If it's a crowded space, then it becomes very, very difficult. So one more question. Yeah. We have not encouraged companies to be B Corps, but I would say some of them have chosen to do that on their own, and that's because as you get bigger, right, and when you get to Series A, people start taking board seats. So being a B Corp actually gives you, the entrepreneur, leverage to push back on certain things, right? So it really depends on the founder. We want to help support you and coach you through that, but we don't necessarily encourage it. So thank you so much. This was great. We appreciate it.